Hi friends, my name is Krishna. Welcome back to my YouTube channel. Today's topic is going to be on DPO. What do you mean by DPO? Days Payable Outstanding. Very interesting topic, guys. This will be very useful for people working in accounts payable department, and this is also helpful for those who are attending interviews. Okay, let us jump on to the topic. Days. What do you mean by days payable outstanding? What our definition says. Days payable outstanding helps us in measuring average time in days that business takes to pay to their suppliers. What does it mean? Let us say there is a business unit. The business unit keeps buying materials, raw materials from the suppliers, and they definitely buy the goods on credit as well as on cash. When they purchase the goods on credit, there will be some pay terms agreed with the suppliers. The pay terms vary from one supplier to other. Some suppliers would have agreed to give credit facility for 30 days. Some suppliers would have agreed to give credit facility for 60 days. Some suppliers would have agreed for 90 days. Some suppliers would have agreed for 120 days. It all depends on the negotiation capability of the business organization or their procurement department, right? They negotiate with the suppliers and they get the pay terms from the suppliers. When they purchase the goods, maybe if the pay term says 30 days, after 30 days they have to make the payment to the suppliers, right? Now the question is, what is the average pay terms? What is the average days company is making payment to the suppliers? For example, I might have 30 days, 60 days, 45 days, 90 days, 120 days pay terms with different suppliers. But how many average days I am taking to make the payment to the suppliers? That is something which every business organization would like to know, right? So that average days company is taking to make the payment to the suppliers is called days payable outstanding. Then how do we calculate this days payable outstanding? That is very important. We need to understand how do we calculate the days payable, right? Very simple formula. See here. Step 1. You need to understand how to calculate accounts payable turnover ratio. This days payable outstanding comes under ratio analysis chapter. So these are all ratios. So if you want to calculate DPO, the step 1 is accounts payable turnover ratio you need to calculate. Step 2. Once we calculate the accounts payable turnover ratio, what we need to do is, you have to take 365 days per year, right? So 365 days divided by whatever figure you got it while calculating the accounts payable turnover ratio, that you need to divide with the 365 days has to be divided by the accounts payable turnover ratio. That is the formula. Sorry, once again I repeat. How do we calculate DPO? Simple. First you need to calculate accounts payable turnover ratio. How do we calculate? That I will explain later. Second step. Once we calculate the accounts payable ratio, what we need to do is, step 2, 365 divided by accounts payable turnover ratio is your DPO. As simple as that. But the question is, how do I calculate accounts payable turnover ratio? That is very important. So let us understand how do we calculate accounts payable turnover ratio. I'll explain with examples. Accounts payable turnover ratio formula is purchases divided by average accounts payable. Purchases divided by average accounts payable. If I take average, what do you mean by average accounts payable? Opening accounts payable plus closing accounts payable divided by 2 is called average accounts payable. For example, if I want to calculate accounts payable turnover ratio for a year, beginning of the year, what is my creditors balance? Accounts payable is nothing but your creditors, right? So what is my beginning accounts payable balance? What is my closing accounts payable balance? We need to take these two figures, add it and divide it by 2 is your average accounts payable. Clear? Once you get the average accounts payable, second thing, you need to figure out what are the purchases you made. So once you get the purchases figure, purchases divided by your average accounts payable is equal to your accounts payable turnover ratio. You can easily get it. But the challenge here is, how do I get the purchases? In our, plus 1, plus 2 or graduation, when we prepare trading and profit and loss account, we used to, say opening balance, 2 opening balance, 2 purchases, by sales, by closing balance, and when we balance that, you get a gross profit. It's very easy to get, right? If you go through the trading and profit and loss account, you get what is your opening balance, what is your purchases, how many goods you sold, and what is your ending closing balance. You will get to see all these figures in your trading and profit and loss account. Is that so easy to get those figures by going through the annual report? Answer is no. You will not get purchases figure directly from the annual report. In annual report, you get beginning of inventory, you get cost of goods sold, you get ending of inventory. These 3 you get. Once again, I am saying, if you go through the annual report of any company, you get beginning inventory. Year beginning, what is the opening balance of inventory? You get closing inventory. What is the closing balance of inventory at the end of the year? That you will get in the annual report. You also get cost of goods sold, but you don't get purchases there. So you need to arrive purchases. It's a very simple formula. How do we, formalize this? Opening balance plus purchases is equal to cost of goods sold plus ending balance. I think most of us know this formula. Again, I repeat. Opening inventory plus purchases is equal to cost of goods sold plus closing inventory. This is a very simple formula. From this formula, you can arrive the purchases figure. For example, if you know the opening inventory, if you know the cost of goods sold, if you know the closing inventory, your purchases equal to cost of goods sold plus closing inventory minus opening inventory is equal to your purchases. Very simple. You get the purchase figure like that. Once you get the purchases figure, purchases divided by your average accounts payable is equal to your accounts turnover ratio. Simple. Once you get this average accounts payable turnover ratio, you know how to calculate the DPO. 365 divided by accounts payable turnover ratio is equal to your DPO. As simple as that. It might be confusing you guys. I'll give you with examples. Let us say my opening inventory. I'm going to explain this with example. Opening inventory is equal to $40,000. I'm just taking an example. My closing inventory is equal to $30,000. My cost of goods sold, COGS, cost of goods sold, is equal to $55,000. Right? My opening accounts payable balance is $5,000. My closing accounts payable is equal to $25,000. Let us take these figures for calculating this. So, what is that first we need to do? You know the opening inventory, $40,000. You know the closing inventory, $30,000. You know the cost of goods sold, $55,000. You know the opening accounts payable balance. Opening accounts payable balance is nothing but your creditors, current liabilities. If you go to the current liabilities in the balance sheet, you will get to know what is our accounts payable balance, opening accounts payable balance. That is $5,000. Closing accounts payable, you will get to see in balance sheet, that is $25,000. These are the figures I took from my annual report. I'm just taking an example. These are the figures I have taken from annual report. Now, what is my first step? First step, I need to calculate the purchases. How do I calculate the purchases? Purchases equal to, here I have given the formula, cost of goods sold plus closing inventory minus opening inventory. Here I already explained, this is the formula. So what is my cost of goods sold here? My cost of goods sold is 55,000 plus my closing inventory is 30,000. 55,000 plus 30,000 minus, what is my opening inventory? $40,000. If I do this calculation, 55 plus 30, 85 minus 40 is equal to $45,000 is my purchases. Straight away I got my purchases. Got it? Now, once I get the purchases, I need to calculate average accounts payable. How do I get the average accounts payable? I already told you. Opening payables plus closing payables by 2 is equal to your average accounts payable. Average accounts payable is equal to opening accounts payable. Beginning of the year, what is my accounts payable? Ending of the year, what is my accounts payable? Add it and divide it by 2. So what is my opening, payables, accounts payable? Opening balance is how much? 5,000 plus, what is my closing, accounts payable? 25,000 divided by 2. How much it will come? 25 plus 5, 30,000 divided by 2 equal to 15,000. Got it? Now, you know the purchases value of 45,000. You know the accounts payable, average accounts payable is $15,000. Now it is easy to calculate accounts payable turnover ratio. What is that accounts payable turnover ratio says? Purchases divided by average accounts payable. Purchases is how much? 45,000 divided by average accounts payable is 15,000. So my accounts payable turnover ratio is equal to 45,000 divided by 15,000 is equal to 3. My accounts payable turnover ratio is 3. That means what? What do you mean by accounts payable turnover ratio? Business unit is making payment to their suppliers 3 times in a year. That is the meaning of it. Accounts payable turnover ratio means business unit or a company is making payment to the suppliers 3 times in that year. This is for an example. It's not that 3 days they will pay and remaining days they don't pay. That is not the meaning of it. I'm just giving you with this calculation, you get to see business unit is making payment to the suppliers 3 times in a year. So you got the accounts payable turnover ratio. Half of the job is over. Now, straight away we go to DPO. How do we calculate DPO now? Very simple. What is the step 1 says? Accounts payable turnover ratio. You got it. 3 is your accounts payable turnover ratio. Step 2, divide 365 by accounts payable ratio. So your DPO is equal to 365 divided by your accounts payable ratio. 365 divided by 3. So it will come 121.6 or some days. Your DPO is 121.6 days. That means this business unit is taking on an average 121 days to make the payment to their suppliers. That is the meaning of this DPO. This business unit is taking 121 days to make the payment to the suppliers. So generally what will happen, what is the benefit of calculating this DPO also we need to understand. Once you get to know the DPO, what will happen, we will compare our DPO, our business unit DPO with the industry. For example, if I am in, chemical industry, for example, if I am in chemical industry, if my DPO is 121 days, what are the other companies in the industry? What is the best in class, or what is the best in class DPO? What are the other companies? How many days other companies are taking? So industry average will be there. For example, if industry average says 60 days average DPO, my company is making payment in 121 days. That means my credibility is not good in the market. My company's credibility is not good in the market. I'm taking 121 days to make the payment to the suppliers, whereas other companies in the same industry are making payment to their suppliers in 60 days. Then obviously suppliers will tend to go to other companies. They don't know ready to supply material to us, right? So that time we need to work and see whether how can we reduce the DPO from 121 days to nearing to the 60 days. That is one. Suppose if my DPO is 60 days and industry DPO is 120 days, the other way around, you can seriously think about negotiating with the suppliers to increase the pay terms so that you can gain some working capital. So this is how the DPO will be looked into by the business units. I hope you are able to understand how to calculate the DPO and what is the importance of DPO and how do we look at the DPO, right? If you like the content, please like my video, subscribe to my channel and share this video with your friends and colleagues. Thank you so much.